Hello, everybody. Thank you for joining us. This class I designed several years back because I felt that every employee in my agency should know these, and not everyone did. So I designed this class, I guess, probably about 10 years ago. And it's come into the fact that now everybody in the insurance industry probably should know these things because no matter what's going on in insurance, this contributes to the ups and downs. So let's get started on number one here. Number one, reinsurance. Reinsurance um, is basically insurance for insurance companies. Okay. So what you have is you have the insurance company who is buying the reinsurance, that they're called the ceding company, and they're buying insurance from reinsurers. And so they enter into an agreement in which case the reinsurer will pay a share of the claims incurred by the ceding company. Um, why is this important? Well, the healthy marketplace, it helps ensure that. And so insurance companies can remain financially stable in the event of a major disaster. So let's go back and just imagine 9/11. 9/11 really was a lot of damage done and very devastating. I can tell you that many of the insurance companies would have been out of business if they didn't have reinsurance. And so what that is reinsurance provides a healthy marketplace, and it provides the ability for the insurance companies to lay off some of the risk. Now, there's basically two methods of reinsurance. One is facultative. And what facultative is that's kind of the minority. Each risk is being underwritten individually. And so I'll give you an example. Let's say you have a building that's insured for $150 million in property coverage. Well, the insurance company who's providing coverage probably isn't putting out that entire $150 million. They may be insuring it in-house for 50 million and then buying another 100 million from the insurance company. Okay. And so that's done on an individual basis. It takes a little bit longer. It's a smaller percentage of the marketplace. Then there's what's called treaty reinsurance. It's basically the insurance company or the ceding company and the reinsurer have negotiated in advance, and they have a contract that says that the reinsurance company is going to insure all of the properties that would fit into this, that the insurance company has, and they will provide reinsurance on all of them. Okay, so basically it automatically covers an entire book of business without underwriting each risk individually. That's probably 70 to 80% of the reinsurance premiums worldwide. Tends to move quicker because they're not underwriting each risk individually. Now, why should you care? We've been in a hard market, which is hopefully ending shortly, the last 5 or 6 years. And some of the reasons you are seeing premium increases is because reinsurance companies have raised their rates for reinsurance. And so that's what triggers. You could have had a building that had zero claims for the last 6 years. They probably still took a beating upon renewal each of the last 5 to 6 years. And a lot of that may be due to the reinsurance company, because what happens is if the insurance company has to pay more for their reinsurance, well, they have to charge you more. And that's why you care about reinsurance. Speaking of 9/11, 9/11 was absolutely devastating in a number of areas. Basically, what happened is most of the damage was reinsured by reinsurance companies. And so prior to 9/11, there were no exclusions for terrorism. Okay, so there was nothing in the policies excluding it. Right after 9/11, insurance companies started filing to have terrorism excluded. And so what basically happened is insurers couldn't obtain terrorism coverage. Mortgage companies were giving a problem providing mortgages or allowing refinances because they wanted terrorism coverage. And so what happened is on November 26th of 2002, President George Bush signed into law the terrorism known as TRIR, the Terrorism Risk Insurance Act. And what that did is that gave insurance companies basically a backstop that if there was ever another terrorist attack, that it wouldn't fall strictly on the insurers, and they pay a premium to do so. Now, what this allowed insurance companies to do is allow insurance companies now basically either have two things. They either have to include it for the insured, or they have to give the insured the ability to reject terrorism coverage. So a lot of the times what you'll see a quote and for both property and liability, and then you might have to sign off either accepting or declining terrorism coverage. And there'll be a cost to do so. So it may be, and it's much more expensive on the property side than the liability side because most terrorism damage is going to be property related, not liability related. So you have the ability to elect or reject terrorism coverage, and there's a premium to do so. Now, that being said, a lot of mortgage companies do require that terrorism is provided as part of the policy. So if you're sitting with a building in the middle of Manhattan, you are probably not going to be able to exclude terrorism. You probably don't want to. Now, for those who do exclude terrorism coverage, you are still going to see a line that says terrorism on your policy. Now, why is that? Even if you reject the terrorism coverage, an insured still has to provide what's called fire following. And fire following basically says, okay, well, the terrorist damage down the block may be excluded, but if that results in a fire that causes damage to our building, that is going to be included. Okay, so regardless of whether you elect or reject terrorism coverage, you are going to have a coverage called fire following. This one is basically the new kid on the block, third-party litigation funding. It is so important to know that we're going to talk about it twice in this presentation. What that is the TPLF is where outside investors are financing lawsuits in exchange for a portion of the award. So basically, it's an investment to them. So you have these alternative investment platforms that are allowing people to invest money, and what they're doing is they are now suing, and lawsuits are expensive. And so now they have money coming in, and this is allowing them to sue more. So not only are they suing more, there's prolonged litigation, so it's longer. The trial and settlements are higher, larger verdicts, and now it encourages new claims that are being filed. So in 2025 alone, 35, almost $36 million in economic damages or losses was tied to the third party litigation funding. And you could expect that will only go up. And so it is something that is new. I do some, besides regular investing, I have a platform where I saw this about 2 years ago, and I was really shocked and horrified by it. But supposedly these investments are taking off, and so what happens is once there is a settlement or a judgment, the people who have invested are returned money and a certain increase in a percentage. So it is driving up the cost, and we're going to talk about this a little later because you're going to wonder why my rates keep going up. This is going to be one of the reasons you need to know about this. Why a condominium or cooperative insurance policy should never include just an LLC. So typically, when a builder wants to develop an association, they form an LLC. Okay, that's generally not always specific to the property. So, for example, if they want to build a condo on 122 Main Street or 123 Main Street, they will typically form an LLC that's 123 Main Street LLC. Now, in order for it to become a condominium, what happens is they got to submit articles of incorporation and other information that's approved by the attorney general. And so at that point, it is still not a condominium. Once a certificate of occupancy is received and the free units are basically sold at that point, generally upon the closing of the first unit, insurance has to be taken out in the name of the condominium because now it is officially a condominium. And so at this point, the developer and the sponsor really isn't responsible for insuring the buildings. They've become just basically the owner or the holder of unsold apartments or unsold shares in a co-op. And realistically, their responsibility is not to insure the building. That's the condominium's responsibility. So a lot of times I see either of two things. I see one, the policy remains in the name of the LLC, which is a problem because we now have a condominium. Or number two, they change the name to the condominium, but they also keep the name of the LLC on it. So it's providing coverage for both the condominium and the LLC. Now, what's happened is once the units are being sold and it's turned over to the condominium, that sponsor slash developer is really just a homeowner at that point. So they may not have sold all the units. So if they still have, let's say, 10 units left, they're responsible for those 10 units. And that's what they should be insuring. Okay. And that doesn't always happen. So eventually, when the board of directors is formed, or the developer sponsor has no majority ownership in the building, they really should be removed as a named insured. That should be the latest date possible. Realistically, when the condominium becomes a condominium, the developer should get their own insurance. There should be no LLC on the policy. It should be only in the condominium's name. So in all reality, the condo or car policy should really never have an LLC as a named insured. They probably should not name them at all because what happens is, let's say there is a lawsuit that is filed against the developer for something that happens inside the unit, or maybe there's damage inside the unit that would have been the owner's responsibility. Well, the developer, being a named insured on the condominiums policy, now has the same rights and coverages as the condominium does, and so it could only drive up the loss history of the condo or the co-op. Indemnification clauses, what are they? Where are they? And why do we need one? Well, first off, let's start with the what. Indemnification clauses for you are the indemnified party. It is a promise by the other party to cover your losses if they do something that causes you harm or causes a third party to sue you. Where? We typically see them in several areas. Here are the four main ones. One, in an agreement between a contractor and our insured. I'm going to go into all four of these a little bit more. Number two, in a lease agreement between a landlord and a commercial tenant. Number three, in a co-op or condominium's bylaws. And number four, in the contract between the management firm and the co-op or condominium. All right, let's start the first one. An agreement between a contractor and our insured. We see it basically in the form of a hold harmless agreement. So when you are getting a hold harmless agreement, and you should, every time you're hiring a contractor, you want to make sure you do. We want the contractor to indemnify our insured for any damages or injuries they cause while doing their work, or as a result of the work that our insured gets named in a lawsuit because of. So why should our insured um, have to report a claim to their insurer? And why should they drive up their own loss history if it's something like where a contractor did something where they dropped equipment off the roof or they injured a passerby or something along those lines? Then they happen all the time. So you always want to have an indemnification agreement between the contractor and you want it to be in the co-op or condo or property owner's favor. Number two, in a lease agreement between a landlord and a commercial tenant. And when I say landlord, this could also be a co-op or condo as well. We want the commercial occupant to indemnify our insured for any damages or injuries they cause, and that gets our insured sued. It's basically the same thing as with the contractor. So you have a commercial space, whether it's a doctor's office, a deli, anything along those lines, people walking in, walking out, they slip, they fall, they're going to sue everybody and every party involved. And so what we want is we want the commercial occupancy's insurance to defend us, and we want them to take responsibility, which the lease agreement and indemnification clause will do. It's also in a corporate condominium's bylaws, and right there it is what it is doing is protecting the board members. Okay, so in the event they are named personally in a suit, and that happens all the time, and insurance is not providing a defense, the corporate condominium will be responsible for their legal fees. So why would anyone want to be a board member or serve on the board if their personal assets are at stake and they weren't going to be reimbursed? And so you will see them typically in the bylaws. I've seen some situations where they aren't. You want to make sure and check yours, but a majority are. And the attorneys these days, especially the ones who specialize in this area, always make sure it is in there. And then lastly, in the contract between the management firm and the co-op or condominium. And so since the management firm does not own the property and does not make the decisions, they need to be provided coverage. Because they are going to be named in every single lawsuit along with the co-op or condo. And sometimes I see them named and without the co-op or condo. And so the management firm doesn't make the decisions, they carry out the decisions of the co-op or condo board. And so what'll happen is if someone is unhappy and they sue and it falls under the D&O, well, automatically we want the D&O policy to provide coverage. And if it's something where it's a liability slip and fall and they're named, well, they want to make sure that they're getting coverage under the liability policy. So the indemnification clause basically requires the co-op or condo to pay their legal fees in the event that they are not being indemnified or covered by the insurance policy. Why is this critical that the management firm always be on an additional insured on there? Because they're named in every lawsuit. And what you would have you'd have situations where the board or the co-op or condo is being covered, but the management firm wasn't. And now they got to reach into their pocket and pay legal fees because of this indemnification clause.
I have two questions.
Sure.
So out of those four, which you think are the worst lawsuits?
Uh, the worst lawsuits are going to be the contractor related ones, because, and we'll get into that a little bit later as well, the labor laws, especially in New York, or realistically in New York, are horrendous, and they're against the property owner. And so a lot of these claims are do hit the seven-figure mark. And that's one of the reasons why we have had so many rate increases the past several years, is because the judgments and settlements have skyrocketed. And and so I'm going to say that's the worst one, because some of these other ones are just everyday claims, but an injury to a contractor, especially in New York, is a major problem.
And how much coverage for D&O policy would someone be comfortable with?
Nothing less than $1 million. And the truth is, I'm going to say it's more important to have a comprehensive policy. And so in this case, quality is much more important than quantity. And so there are carriers who will allow you to include the D&O coverage under the liability policy. It's probably $250 to $300. It's not worth the paper it's written on. So you want a standalone policy with a Travelers or a CNA or Chubb or one of those companies. You may pay $3,000 for it, but it is much better and much more comprehensive policy. So at the very least, you want $1 million. This day, it's hit or miss whether the umbrella sits on top of them. So it used to be 5, 6 years ago, the umbrella would provide excess coverage over the D&O policy. Some do, some don't. So if your umbrella isn't providing excess coverage, see if you can get a $2 million limit, or sometimes more. But I'm a minimum of $1 million.
Gotcha.
Number six, this one is a confusing one. Uh, Basically, auto insurance typically provides coverage for damage caused within the building by delivery, not general liability. So a lot of buildings have, listen, they have owners. When the owners move in, do whatever they have deliveries. And so they're always getting certificates of insurance, and they're getting this, that, and the other thing. And it typically it's focused on liability insurance. But the way the typical insurance policy reads is that the auto policy provides coverage for accidents that occur while unloading is being done from a covered auto to the place where the property is finally delivered. And the general liability policy provides coverage before loading has begun. So let's say at the store or the warehouse, and after it's reached its final destination. And that typically is the unit where it's going to. And so I've seen situations, and I've seen it adjusted both ways. I've seen the liability policy respond. I've seen a liability policy say, no, it's the auto policy's responsibility. But that is the wording right there that you see with the two bullet points of who's responsible. And again, so if something falls off the truck and injures someone, if they're carrying it into the building and someone gets injured or something gets damaged, typically it's supposed to be the auto policy that provides coverage. So my suggestion is anytime you are having moving companies in a lot that are moving furniture and things into the building, I would make sure that they have both commercial auto insurance and general liability insurance to take away the confusion. Because again, I've seen it adjusted both ways. And what you don't want is you don't want the carrier coming back and saying, well, they only had general liability. They didn't have auto insurance. It was in the process of being unloaded or being delivered into its final destination. And so it's not covered. So make sure that they have both coverages. A person can be considered an employee for workers' compensation purposes, even if they are not on payroll. And this is something that surprises people. It used to be typically that you would say, okay, well, the easiest way to determine who is an employee is, okay, well, they're on payroll. We withhold taxes. They get a W-2 at the end of the year. Employee. They don't. We issue them a 1099 at the end of the year. Not an employee. That is no longer true. Probably hasn't been true forever, but really what has happened now is it's become more prevalent. So what the compensation board has basically said is the distinction between an employee and an independent contractor is that the employer has the right to control and direct the activities of an employee, not only as to the result to be accomplished, but also as to the method and means by which the result is obtained. So if you hire, let's say, a contractor to come into the building and do the same duties the super does, and you tell him he's got to work Monday through Friday, 9 to 5, you give him all the equipment, you tell him what he has to do each day. He may not be on payroll, but I can tell you if he gets injured, he is an employee. Okay. So keep that in mind. If an employer is controlling and directing the activity of a person not on payroll, that person may still be considered an employee by the compensation board and eligible for workers' compensation benefits. And if you have workers' compensation coverage, what you pay that quote unquote employee, that independent contractor, now becomes your payroll. So you may be thinking, all right, I'm going to hire a super who can just give him a 1099, not put him on payroll. Now you've paid him whatever it is, $70,000 for that year. Well, it turns out that now he is considered an employee. Now you're paying premium based on that payroll. Okay. And if you don't have workers' compensation coverage and that quote unquote employee is injured, not only could you be penalized by the compensation board, um, which is very expensive, it's usually $2,000 for every 10 days of not having any coverage, but you would also be responsible for lost wages, injuries, etc. So it is very important to understand the distinction, and it is very important to make sure that you have workers' compensation. And if you're not carrying workers' compensation, these independent contractors slash employees need to cover it, or need to have their own, or else it's going to fall back on you. Because in all cases where they're, whether it's a W-2 or a 1099, who is being considered an employee, you are responsible and be considered their employee. All right. This page always seems to interest everyone. Why do my liability rates always seem to increase and they don't decrease? Insurance is cyclical, and I used to be able to say it goes up, it goes down, it goes up, it goes down like a roller coaster. So you may have a hard market, which we've talked a little bit about, which is increasing rates, insurance companies not wanting to provide coverage or quotes, or they've tighter requirements in terms of life safety, et cetera. Then a soft market is kind of the opposite. Soft market insurance companies are looking to obtain premium because they want to invest and make investment income. And so what that does is that drives down premiums. And it used to be up and down. We are basically, or have been, in a hard market for the last 5 to 6 years. Now rates are starting to soften out there, but they're only softening really on the property side. So there was a newsletter that I read every week that I saw the other day. It basically said that property insurance rates of the last couple of quarters have gone down about 6 or 7%, and workers' compensation, but every other policy, which is pretty much liability based, has gone up. And so they continue to go up. And here are the reasons why. Number one, and this is not in any kind of order here, social inflation and changing jury behavior. So basically, social inflation refers to the rise in insurance claim costs driven not by economic factors like medical or wage inflation, but by changes in basically society's attitudes, okay, the legal system behavior and litigation trends. So basically, in other words, it's people who for whatever reason, and sometimes it's a younger generation, sometimes it's just trust for insurance companies, are giving money away. And that is countrywide. So it continues to be the single biggest driver increasing liability costs. So what could have been a $250,000 judgment a couple of years ago is now seven figures. And that does not seem to be changing. So they did a poll relatively recent regarding, because there's been a lot more nuclear judgments, which are $10 million or more, which we're going to get into next. And people basically indicated that they didn't feel that they felt that there weren't enough and they were okay with these awards. And so we're going to get into that. Number two, there are larger jury awards now known as nuclear verdicts. There are jury awards of $10 million plus. They have surged. There was 135 nuclear verdicts totaling 31 billion, and that was in 2024. I don't have the 2025 numbers; they weren't released as of last week, but those numbers are only going to go up based on the statistics and based on the polls that, again, people have indicated they don't feel there's too many lawsuits and they don't feel that there are too many judgments being paid. We talked about a shift in juror attitudes. Jurors are showing an increased sympathy towards plaintiffs and stronger anti-corporate bias. They are recommending larger awards even against smaller businesses. And, you always see some of these There was one probably 6 or 8 months ago, and I've seen this one before. It's happened several times. Someone gets a cup of coffee from Starbucks or McDonald's or wherever they get it from. The cap, isn't on tight enough, or at least that they say was it. They spill, they get burned, they sue. And I think there was one. It was something like $50 million recently. There was another one where uh, basically the same thing happened in the car. The auto insurer was dragged into it. I mean, it's so people are suing, and the juries are much more sympathetic. And what that does is it causes two things. It causes either larger judgments when the insurance companies go to court, or what it does, it forces the insurance companies to settle. And so sometimes they will decide, I don't want to fight this lawsuit. It's going to cost me less to just pay the settlement and settle it than for me to go to court. And so that's what happens. It's a pure business decision. It happens all the time, but that is what's causing that. Litigation as a social norm. As I was just indicating, fewer Americans believe there are too many lawsuits. So they're basically that kind of thinking encourages more litigation. We talked about third-party funding, litigation funding. It's becoming more and more popular. This has only been around, I don't know, 2 years or so. At least that's when I heard about it the first time. Uh, I can tell you, unless laws are put into place, it's going to continue to happen. And so what happens is it's not even like the insurance companies or excuse me, it's not even like the juries. So if this goes if there's a claim that's being filed, the juries don't know that it's being funded by investors, which so they don't because the attorneys and insurance they don't have to disclose this. So in my opinion, I think that it would probably, if a jury was aware that this was basically an investment for people, that they may think twice about awarding large settlements because or large judgments because it's not going to the injured party. Basically, it's going to investors. And then lastly, we talked a little bit about it. Kevin, that was your question earlier. What's another thing driving up the liability rates is unfriendly label laws. And really, that's specific to New York. It's really the only state that has them that is so detrimental against the property owner. So the label laws are very unfriendly towards the property owner, and many injury to contractor lawsuits are, though frivolous, are still either paid out by jury. Okay, we've talked about that. A larger jury awards, or the insurance company has to settle. So the number of lawsuits filed are on the rise in all of these aspects, and that is the reason why, although the market has changed a little bit, we are not going to see a full-blown soft market right now because liability rates and the umbrella rates are continuing to go up. Number 9, NFIP, National Flood. Their flood policy for condominiums includes improvements and betterments, and some people don't realize that. So if you write a flood policy for a co-op or a rental property, it's basically considered a commercial building. You get $500,000. Here's what it covers. It's relatively simple. A condominium works different. So a condominium, the policy they take out is called an RC-BAP, Residential Condominium Building Association policy, and that provides coverage for the improvements that the owners have made. Okay, so let's take a step back. In most instances, the owners have responsibility in almost every case for the improvements they make in the unit. So if there's a fire in the unit or a burst pipe or something along those lines, the association is responsible for putting floors, walls, ceilings back together. If it's the original kitchen, things like that. But if an owner has gone in and improved the bathroom, kitchen, and all that, happens very often, typically if due to that peril of fire or water damage to the association, the owner becomes responsible for the improvements. That's not the case with the flood policy, the RC-BAP. So all improvements made by the owners are considered part of the building, and the RC-BAP policy will cover improvements. And I had a situation years back where a board was very unhappy because they had a fire, and the insurance company went in and did not pay for the improvements. Excuse me, they had a flood, and the flood company went in and paid for all the improvements. And then a couple of years later, they had a fire, and the insurance company that provided coverage to the building did not pay for the improvements. improvements. And it really turned into threats of lawsuits and things like that. Well, you guys covered the improvements the first time around, you didn't cover the improvements the second time around. And so it was kind of hard to drill this through the head that in most perils that are covered under the building policy, the improvements, as per the bylaws, are the owner's responsibility. And but the RC BAP policy for flood includes the improvements. So two different areas there. And number 10, last but not least, shareholders in a co-op cannot get flood insurance for the structure. Okay, and then we'll go into co-ops cannot get as much coverage as condominiums. So unit owners in a condo can purchase dwelling coverage in the event they need it. Okay, since shareholders in the co-op do not actually own the unit, only shares in the building, they cannot purchase a flood policy to provide dwelling coverage. They can only insure their contents, so they can get a flood policy, but they can only insure their contents. Uh, However, a flood policy for a shareholder will include coverage for the improvements or betterments at 10% of the contents limits to a maximum of $10,000, and that being because $100,000 in contents is the maximum offered by NFIP. So again, if you need coverage for your contents and you live in a co-op and you can take flood coverage and cover that, and 10% of that will be used for the improvements or betterments. In terms of coverage for the actual building, as I mentioned before, co-ops are considered commercial buildings, much like an apartment or a commercial property, and they can only purchase up to $500,000 in flood coverage through NFIP. Now, condos again have their own flood policy called the RC BAP, Residential Condominium Building Association policy, that allows them to purchase either, keep this in mind, $250,000 per unit or 100% of the replacement value, whichever is less. Now, the downside to this is the condominium cannot purchase less than 80% of the replacement value or 250,000 per unit, whichever is less, or else they are considered underinsured and they'll be hit with a co-insurance penalty in the event of a flood claim. Now, I know it's very confusing. So think of it this way. If you have a building that is insured for $10 million and it has 10 units, well, the most that that condo is going to be able to get is $2.5 million in flood coverage, okay? Because they could have obtained $10 million, which is 100% of the replacement value, but the lesser of it is 250,000 per unit. So the maximum they're able to obtain is $2.5 million in flood coverage. Now, let's say it was 60 units and the least amount of it, the lesser of the two was 100%. Well, they could have gotten up to as much as $10 million worth of flood coverage. So it's the lesser of the two. And keep in mind, if you are able to get, it's not like I've had condo buildings who come to me and say, well, we don't want $5 million worth of flood coverage, which is what we want 500,000. Well, you need to take out at least 80% of the replacement value in that situation. So in the situation we were just talking about where they could obtain up to $10 million, you have to take out at least $8 million. Okay. And if you don't take out $8 million, let's hypothetically say you took out $1 million flood policy. Well, you've only taken out 12.5% of what you could have. And now the flood company, in the event of a flood claim, is only going to pay 12.5% of your claim. So you might have $1 million claim. They're only going to pay whatever it is, $125,000 of it. So keep that in mind. Flood coverage tends to be confusing, and that's why you rely on your broker. And again, it's one of the reasons why I put together this class, because most people aren't going to know most of these, as it really is something that kind of out of the norm. All right, let's see. Let's see if we have any questions here. Kevin, do you have any before?
Um, no, you pretty much covered everything I was going to ask.
Okay.
I think we have
We
some
have
questions in the chat.
we do. Okay. We have a question. How do you define worst? And I'm assuming that's probably based on the question you asked before in terms of what would be the worst claim. And when I define worst, my definition of it is probably the highest judgment or settlements. And that was related to the indemnification clauses. But it's all subjective. You know, if you're sitting on the board, you want to make sure that your building has the bylaws that have an indemnification clause in there. Because so to me, then if I'm sitting on the board and I don't have coverage in the event, and I got to reach into my pocket if I'm named in a lawsuit, well, to me that's worst. Number two, what about insurance for a fire claim and if the building is destroyed? Uh, Not 100% sure I understand the question, but what about insurance for a fire claim? Well, fire is a covered peril. It's the main peril under an insurance policy, the property policy. So basically, all policies are going to provide fire coverage. Now, the insurance company, the policy typically, although it'll say we cover this, this, and this, insurance companies go by the governing documents of the association. And we teach a class called It's Not Natural to Live in a Condo or It's Not Natural to Live in a Co-op. And what it goes into in there is there's several different ways that these governing documents can be written. And co-ops are typically one way. Condos can be one of three ways, and we'll go into them. Condos can be written as bare walls, which means the association is responsible for the floor, the wall, the ceiling, and the owner has everything in it, including cabinets and partition walls. Then you have all-in coverage, which means the association is responsible for everything, including improvements. We don't see that too often. The most common way the condos are written and all co-ops are written is the association is responsible for putting the unit, the building, and the unit back to its condition at the original time it was conveyed. And so when you ask what about fire, the association basically, again, the way their governing documents are written is the way the insurance company is going to pay. And in most instances, the insurance company is going to pay for to put the building back to the condition it was in prior to the loss, minus the improvements made by the owners. Can you talk about what we've been seeing with umbrella policies? Do you think co-ops will still be able to get 25, 15, or 10 million in coverage in the future? What is the minimum co-op should have? I'm going to start with the second question. What is the minimum co-op should have? Right now, and I don't know if that's changing, I would suggest what you can obtain and what you can afford. Okay. So you may have instances where you could probably get 100 million if you still want. What happens is you may get 10 million with one company, 10 million with another, 5 million with another, and then they'll layer up like a ladder to 100 million. It's tremendously expensive. Okay. So my suggestion is you have to weigh what the cost is. So it's not, first off, can you obtain more than, 5 million? And if so, what is the cost to do so? I've seen plenty of buildings. We insure almost 2,000 co-ops and condos at this point, and I would say 5 or 6 years ago, every single one of them had 100 million, and the ones that didn't have 100 million had 50 million. Okay, and they were paying pennies on the dollar. Well, that's changed. I mean that's long gone now. I'm going to say 50 to 60% of our buildings now probably have $10 million. Some of them have 5 million because it's become much more difficult to obtain coverage. And so, again, the first question is can you obtain more than that? And if so, weigh what the cost is and make sure it's affordable. I mean, we had a co-op, excuse me, a condo recently who we just wrote the insurance for, but we took over their umbrella because there were no other options. But their umbrella went from $75 million down to 25 million because that program doesn't offer more than 25 million anymore. And the premium went from 30,000 to 125,000. So the limit went down two-thirds, and the premium went up 5 times as much, basically. So I don't see that changing in the near future because what we just talked about, the 6 reasons why, the third-party litigation funding, labor loss, things like that, those claims are not stopping. They're increasing. The judgments are going up. So I don't see that stopping. I don't see new umbrella markets coming in. I do see markets, new carriers coming in to write property and even liability, but I don't see really new ones coming in to write the umbrellas. And when it comes to the umbrellas, competition is what drives the rate down. So I do think you'll be able to still get 5 and 10 million. Whether more than 10 million, that may change in the future because the same carriers who are still offering 25 or so were offering 100 to 200 million only a couple of years ago. So those may come down. Could you clarify if you have a super who receives a 1099 at the end of the year, a condo building should take out workers' compensation for the individual? Yes. A condo who has any work like that coming in, even if they're on a 1099 basis, should have their own workers' compensation policy. And it's basically done on an if any basis, meaning if any payroll is there. And so what that does is you need to make sure, like I said before, is you are the employer. And the way the compensation board looks at it is if either you have to maintain insurance or they have to maintain insurance. So if you have a super who's on a 1099 and he does not maintain his own workers' compensation insurance, then yes, you should take out a workers' compensation policy. It's not exclusive to that individual. So it's not, hey, we took out a workers' comp policy. It's in the name of John Smith. It's in the name of the association, and it could cover John Smith and every other people who are working at the building. Does the D&O policy include the cost of litigation, the effect of which is to reduce the amount of individual coverage available? I'm sorry, I need to reread that. Does the D&O policy limit include the cost of litigation, the effects of which is to reduce the amount of individual coverage available? So I think what the question is does the limit reduce based um, on legal fees? Because most liability policies, the legal fees are outside the contract, and the limit is basically for judgments and settlements. D&O policies can go either way. Okay, so you have some companies that will have defense costs outside the limit, which is great because defense costs are basically, you could say, unlimited, and that limit is for judgments. And then you have other companies where the defense costs reduce the limit of liability. So it can go either way. If you can get it outside that's wonderful. If you can't, then that's where your umbrella typically comes into play. And the last question: do workers' comp coverages and disability go hand in hand? And meaning are both required. In New York, if you have any employees that are on payroll, yes, you need to maintain workers' compensation and disability. Okay. And let's just take a step back. So when I said on payroll, you have those 1099 employees not considered on, they're not on payroll, but they could be considered employees. You definitely want to maintain workers' compensation. Okay. So in all instances, you should maintain workers' compensation. Disability, if you have employees on payroll, the answer is yes. If you don't have employees on payroll, those 1099 employees you're not required to have disability insurance for them. Excuse me. Now that being said, the disability insurance for a male is like $3 a month and a female $7 or $8 a month. So it's not something that's tremendously expensive, but they go hand in hand when you do have someone on payroll because you can and will be penalized by the state if you have employees on payroll and you don't maintain both. Okay, I'm just going to show our contact info here. If you have any questions that just come to mind after or you didn't want to ask, here's our email addresses, is QR code. Please reach out to Kevin and myself. We are always there. Thank you and have a great day.